Up until now, we've primarily been focusing on service operations, something like an accounting service or legal services or consulting services. In this video, we're going to be talking about merchandising operations. That refers to a business that is buying and selling a product or products for a profit. There are two types of merchandisers that we can consider: retailers that sell to an end consumer, and wholesalers that sell to the retailer. Before we go further, it's important to understand that in accounting, we usually don't refer to products as products. We call them inventory or goods. A good is a tangible, that means physical, item that satisfies a need or provides a benefit. Examples include food, toys, clothes, and furniture. The financial statements of a service company and a merchandising company are a little different. Let's take a look at a service company. You'll recall that on the balance sheet, we classify the balance sheet into current assets and long-lived assets. Under current assets, we'll have things like cash and accounts receivable. In the income statement, we have service revenue, less all of our expenses, and that yields net income or net loss. We can contrast this to the financial statements of a merchandising company. Under the balance sheet, we will still classify assets as being current or long-lived, but under current assets, we introduce a new account called inventory. So the products or goods on the balance sheet are referred to as inventory. On the income statement, instead of service revenue, we now have sales revenue. And from that, we subtract the cost of goods sold. The cost of goods sold is just that, the cost of the inventory that was sold. If we subtract the cost of goods sold from sales revenue, we get a new subtotal called gross profit. And from that, we subtract the remaining operating expenses. You can see here that the expenses are listed in multiple steps, and we'll refer to this as a multi-step income statement. So remember, for a merchandising operation, we have at least two new accounts: inventory and cost of goods sold. When accounting for inventory, we can use one of two systems: a perpetual system or a periodic system. In a perpetual inventory system, we maintain a continuous record of cost and quantity of inventory on hand. We can contrast that with a periodic inventory system. A periodic inventory system is updated at the end of the period. Cost of goods sold is calculated based on a physical counting of inventory. In a perpetual inventory system, we can determine what the cost and quantity of inventory is at any given time during the period. Whereas for a periodic system of inventory, we do all of that at the very end of the period. So that's a quick overview of the differences between a service operation and a merchandising operation, and the fact that we have two different systems of inventory that we can use. In our next video, we'll be taking a deeper look at a perpetual system of inventory.